Drilling junta has given foreign companies until the end of May to submit proposals and a timetable for the construction of bauxite refineries. Colonel Mamadou Doumbouya on Saturday told industrialists to do this before the end of May and to ensure all raw materials used in the manufacturing process be produced locally. The junta head also warns that foreign companies that violate the refinery construction deadlines will be penalized. With an estimated 7.4 billion tons, Guinea has the world's largest reserves of bauxite, a mineral used in the manufacture of aluminium, which is essential for the automotive and food industries. It is also the second largest producer. China imports about half of its bauxite needs from Guinea. However, the benefits to Guinea from bauxite mining and other abundant natural resources such as iron, gold, and diamonds are notoriously disproportionate. Experts cite insufficient investment.
Welcome to AfriGlobal 24, your trusted source for breaking news, deep insights, and stories shaping Africa and the world. Stay informed, stay connected, and experience the news that matters. Right here, 24/7.
In the heart of West Africa, a decision has sent shockwaves through the global economy. A single nation long overlooked, often underestimated, has brought the world's largest industrial powers to their knees. That nation is Guinea. For decades, it quietly supplied the backbone of modern industry, bauxite and iron ore, the essential minerals used in aluminum and steel. From aircraft and smartphones to construction and electric vehicles, these resources shaped the modern age. But now, Guinea has cut off exports of both bauxite and iron to the West, in a move that analysts say could rewrite the rules of global trade. The global mining market is now facing what some economists call a $7 trillion shock. It's not just a trade dispute, it's a geopolitical earthquake. Factories in the West are already reporting production halts. Aluminum smelters are running low on raw material. Construction firms warn of rising costs. And behind it all, a quiet but deliberate strategy, led by a nation determined to control its destiny. For years, Guinea supplied over 25% of the world's bauxite, the ore from which aluminum is made. Most of it went to Western markets and multinational corporations who built billion-dollar industries on Guinea soil, often without Guineans seeing much of the wealth. The deal was simple, or so it seemed. Guinea exported raw materials. Foreign investors took the profits. Until now. In early 2025, Guinea's transitional government, backed by the country's National Mining Council, announced sweeping reforms. Among them, a temporary suspension of bauxite and iron ore exports to the West, pending new terms that prioritize local refining and African trade first. Guinea would no longer be the raw materials pit of the world. The timing couldn't have been more explosive. Across the Atlantic, Western industries are already battling high energy prices and inflation. In the United States, manufacturing indexes have been sliding for months. Europe's steel and alumina sectors are under pressure from rising costs and global competition. And now with Guinea's move, supply chains have fractured overnight. Analysts estimate that Guinea's bauxite accounts for nearly half of the aluminum used by Western manufacturers. Without it, industries from aerospace to packaging could face massive shortages within weeks. But Guinea's decision wasn't made in isolation. It is part of a broader wave of resource nationalism sweeping across Africa. A movement demanding fair trade, local processing, and sovereignty over natural wealth. To understand how we reached this breaking point, we have to look at history. Guinea is home to some of the largest untapped reserves of bauxite and iron ore on Earth. Its red hills contain minerals worth trillions wealth that could power entire economies. But for decades, foreign mining giants dominated extraction, export, and pricing. Local communities often saw little return beyond low wages and environmental scars. In recent years, Guinean leaders began to question that balance. Why should a nation so rich in resources remain dependent on foreign aid? Why should the raw materials that shape airplanes and cars leave its shores? Long simmering beneath the surface has now erupted into policy. In March 2025, the government officially ordered all mining operators to present new plans for local refining and value addition. Companies that refused faced suspension or contract review. And when several Western firms hesitated, Conakry didn't blink. Instead, the government signed new strategic agreements with African and Asian partners to develop regional processing hubs. This was not just about Guinea. It was about reshaping Africa's position in the global value chain. Within weeks, the impact became undeniable. Western buyers scrambled to secure alternative supplies from Australia, Brazil, even Canada. But global shipping bottlenecks and rising fuel costs made replacement nearly impossible. Prices surged, manufacturers sounded alarms, and on the markets, traders whispered what many feared to say aloud. Africa has leverage. Guinea's move may seem radical, but it follows a clear logic. By withholding raw exports, the country forces international firms to invest in domestic processing plants, ensuring that jobs, technology, and profits remain within its borders. It's a play straight out of the economic sovereignty doctrine first championed by leaders like Thomas Sankara and Kwame Nkrumah. The idea that true independence requires control over production, not just resources. And in 2025, Guinea has revived that idea, not as a slogan, but a state policy. For the global north, this is more than a trade dispute. It's a reckoning, one that forces Western economies to confront their dependence on African minerals, because without Africa's bauxite, iron ore, cobalt, and lithium, the machinery of modern civilization simply stops. And now, for the first time in history, Africa knows it. As factories grind to a halt and the markets panic, the world begins to realize what Guinea's leaders have been saying all along. You can control the technology, you can control the currency, but without Africa's minerals, you control nothing. This is not just a mining disruption. This is a global reset. Within 72 hours of Guinea's announcement, panic rippled across the industrialized world. Stock markets shuddered. Commodity prices exploded. Aluminum futures surged by more than 40%. For nations that once controlled global trade, this was unthinkable. A single African country had triggered what analysts now call the greatest mineral supply shock in modern history. In Washington and Brussels, emergency meetings were called. Trade ministers convened with mining executives, searching for solutions. But there were none. The bauxite-rich belts of Guinea, stretching from Bauxite to Kindia, are not easily replaceable. Australia and Brazil have deposits. Yes, but logistical constraints, environmental regulations, and high extraction costs make substitution nearly impossible in the short term. The world had built an entire industrial supply chain on the assumption that Africa would always export. Now that assumption had collapsed. In Europe, major automotive and aerospace companies issued warnings of production delays. In the US, construction firms began rationing aluminum supplies. And as the crisis deepened, a new fear emerged: inflation. Without raw materials, production slowed. With demand still high, prices so added. Every item that relied on alumina, from soda cans to satellites, became more expensive. It wasn't just an industrial shock, it was a consumer crisis. But while the West scrambled, Africa was moving differently. In a rare show of solidarity, several African nations publicly supported Guinea's decision, praising its demand for fairer mining contracts. Mali, Niger, and Burkina Faso, already leading a wave of economic nationalism, announced plans to review their own mineral export agreements. The message was unmistakable. Africa was no longer content with exporting its wealth without value. We are not shutting the door to trade, one official said. We are opening the door to fair trade. Behind closed doors, regional blocs began forming what some analysts call the African Minerals Alliance, an informal coalition of states exploring joint control over strategic exports. By coordinating production, pricing, and processing, African nations could finally gain leverage in a market long dominated by global conglomerates. It's a model inspired by the oil-producing nations of the 1970s. But this time, it's minerals, not petroleum, at the center of power. And Guinea's decision, once seen as radical, now looked visionary. Meanwhile, in the boardrooms of global financial institutions, alarms were ringing. The International Monetary Fund and the World Bank expressed concern about the potential destabilization of global supply chains. But critics noted a deeper worry. For decades, these institutions had relied on Africa's dependence loans, debt restructuring, and conditional aid, all tied to the export of raw resources. Now, if those exports slowed, so too did the leverage. Africa, for once, held the upper hand. Guinea's finance ministry clarified that this was not a permanent ban. It was a restructuring phase, designed to ensure all future mining deals include mandatory local refining of at least 30% of output, joint ownership stakes for the Guinean state, and technology transfer commitments from foreign investors. Essentially, the government demanded that if the world wanted Guinean minerals, it had to help build Guinean industry. Construction has already begun on the first local aluminum smelter near Bauxite, part of a new industrial zone designed to process raw or into finished metal. Thousands of jobs are expected to be created. Technical schools are being built to train local engineers. For the first time, Guineans are not just mining their soil, they are shaping their future. But make no mistake, this shift comes with risk. Global investors have paused some operations. Foreign media warn of economic retaliation, and behind the scenes, diplomatic pressure is mounting, urging Conakry to reconsider. Still, Guinean officials remain unmoved. They argue that the short-term turbulence is a necessary price for long-term sovereignty. As one economist in Conakry put it, "For 60 years, we've exported our wealth and imported poverty. That era is over." While the West grapples with shortages, Guinea has quietly pivoted eastward. Asian buyers have shown willingness to invest in processing plants directly in West Africa, cutting shipping times and boosting regional employment. Meanwhile, African regional markets, particularly ECOWAS, and the African Continental Free Trade Area, AFCFTA, are exploring how to absorb some of Guinea's refined output domestically. What was once a single-country decision is now transforming into a continental strategy. In the span of just a few months, Guinea has forced the world to confront an uncomfortable truth, that industrial power is only as strong as its access to raw materials. And when those materials lie under African soil, Africa decides the rules. In the West, policymakers call it economic disruption. In Africa, they call it rebalancing. Either way, the message is clear. Guinea has changed the equation, and the question now facing global markets is not whether this crisis will end, but what happens when other African nations follow. It has been 6 months since Guinea announced its export suspension. The initial shock has faded, but the aftershocks are still being felt around the world. Factories in the West remain under strain. Commodity prices have stabilized but at record highs, and global analysts now describe Guinea as a decision, as the moment the global South found its leverage, because what began as an isolated act of defiance has transformed into a continental awakening. In the wake of Guinea's stand, a wave of new policies has swept across Africa. Mali announced a moratorium on new foreign mining concessions pending review. Niger began negotiating joint venture terms for uranium and iron production. Tanzania introduced export controls to protect its nickel reserves. And in South Africa, lawmakers debated requiring that 70% of mine minerals be processed domestically before export. Across the continent, leaders were taking the same message to heart. Africa must own its value chain. For decades, the global economy was structured around one silent assumption, that Africa would remain the supplier of raw materials, while the rest of the world would handle the profits. Now, that model is breaking. Guinea's move forced major corporations to reconsider their approach. Instead of extracting and exporting, some are now negotiating to build processing plants directly in Africa. Industrial parks in Guinea, Senegal, and Ghana are seeing a surge of foreign and regional interests. Local entrepreneurs are being invited to the table. Technology transfer, once a buzzword, is becoming a requirement. In short, Africa is no longer begging for partnership. It's defining it. In Bauxite, a once quiet mining town, construction has begun on Guinea's first aluminum smelter, built entirely with local and regional expertise. Young engineers from universities across West Africa are training side by side with seasoned miners. The vision is simple: turn the red dust of Guinea into finished products made in Africa. This transformation may take years, but the foundation has been laid. For Mani, this moment feels like a continuation of the unfinished dreams of the 1960s. The dream of an Africa that doesn't just export, but creates, manufactures, and controls. But the new reality is not without tension. Western governments, facing shortages and rising prices, have quietly urged Guinea to resume full exports. Diplomatic envoys shuttle between capitals, offering aid packages and new trade incentives. Yet Guinea's government remains cautious, determined not to trade independence for convenience. As one minister stated during a press conference, "We are not closing our minds. We are reopening our future in Washington." Think tanks now refer to Guinea's policy as part of a broader resource realignment. They warn that if similar actions spread to other mineral-rich nations, global manufacturing could face structural disruption. Because Guinea is not alone. Africa holds over 30% of the world's mineral reserves, including cobalt, lithium, manganese, and iron. All vital for clean energy and technology. If African nations begin coordinating their export policies, the balance of global industrial power could shift permanently. For now, the world is adjusting. Alternative suppliers have increased output, but logistics and environmental pressures limit expansion. Western factories have resumed partial operations, often sourcing from more expensive and distant markets. And quietly, new partnerships are forming between African states and Asian, Middle Eastern, and South American investors who see opportunity in this new order. The age of unilateral Western control over Africa's minerals is coming to an end. In Guinea, the policy's domestic impact is already visible. Government revenues are up. Small-scale businesses around the mining sector, transporters, suppliers, service providers are flourishing. Public investments in schools and infrastructure have increased. Critics still warn of risks, corruption, governance, challenges, and capacity gaps. But supporters argue that these are growing pains of independence, not signs of failure. After all, for the first time in living memory, Guinea is dictating its own economic terms. And that's the real story here. Not just a shock to Western markets, not just the trillions at stake, but the symbolism, the idea that a single nation, through sheer conviction, could force the world to listen. Guinea's act was not one of isolation, but of assertion. It said to the world, "We are not your supply chain, we are your partners." That message has now echoed from the Atlantic coast to the Horn of Africa. Whether you call it a mining shock or a market correction, one fact remains undeniable. Africa is rising from beneath its own soil. Guinea's bauxite and iron ore may have sparked this fire, but the flames now reach across an entire continent hungry for equity, respect, and control of its destiny. From Ouagadougou to Kinshasa, from Nairobi to Johannesburg, the narrative is changing. Africa is no longer waiting for permission. It is setting the price, writing the contracts, and shaping the terms of tomorrow's world. The global economy was built on the assumption that Africa would always remain the supplier. But today, Guinea has proven otherwise. Because when Africa decides to keep its wealth, the world listens, the markets tremble, and history begins again.
You've been watching AfriGlobal 24, your window into Africa and the world. If you found this video informative, don't forget to like, share, and subscribe to stay updated on the latest stories shaping our continent and beyond. Hit the notification bell so you never miss a report. And join the conversation in the comments below. Until next time, this is AfriGlobal 24, bringing Africa closer to the globe 24 hours a day.